Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Unemployment rose slightly in March to 3.8%, better than market expectations. Many economists had been expecting a larger jump. That's particularly after the big fall in February. So what's it mean for wages and for interest rates? And what about the confirmation from the US Fed this week that rates are going to stay higher for longer? Plenty to discuss. Stephen Halmarick is Commonwealth Bank's Chief Economist. Stephen, welcome back to Fear and Greed.
My pleasure. Thanks, Sean.
First to yesterday's unemployment numbers, the labour force stats from the Bureau. Was it better than you were expecting? What do you make of them?
Well, it was actually pretty close to our forecast. We were looking for unchained employment on the month, and it was down just on a bit over 6,500. And we were thinking the unemployment rate might go from 3.7% back up to 3.9%. But as you said, it was 3.8%. But actually, to the second decimal place, it was 3.84%. So I'm going to say that was very close to our forecast.
Okay. What do you make of the labour market? It just seems stronger than we expected it to be.
Yeah. So if you look at the economic growth numbers, the GDP numbers, they would suggest that the labour market should have been weaker than it's been over recent months. The February employment report was particularly strong, so a little bit of a payback in March. The labour market's loosening, but loosening very slowly. We expect that process to continue throughout the course of this year because bottom line is, economic growth is lower than trend. We're not creating enough jobs every month to account for the increase in the labour force due to population growth. So the unemployment rate should continue to drift higher, but it's happening pretty gradually.
Why is that though? Why has the labour market surprised everyone on the upside? Why is it taking so long to lose jobs?
Well, I think the question there is, where are the jobs being created? And if you look at the industries where the biggest increase in jobs has been, by far the biggest increase is in health and aged care. And we've been looking at some data which shows over quite a number of years, the increase in the number of health-related jobs in Australia was very similar to other countries like the US and Canada. And then a few years ago, we started increasing our health jobs much faster than the other countries. And that's really aligned with the start of the NDIS. So health is the largest increase in jobs over the last year or so. And the second largest is utilities, water, electricity, energy. Different pattern than we're seeing in other countries where really health and utility jobs have been the big driver. When you look at other sectors like services and hospitality and food and beverage and agri and manufacturing, the growth in jobs is much weaker.
That's interesting. So maybe it's actually a government policy decision a few years back, which is just changing the trajectory of the employment market this particular economic cycle.
Yes, I think that's right. And the other thing to highlight is the number of people with multiple jobs is also increased substantially. Post-COVID or through COVID, post-COVID. And that's probably a reflection of the cost of living issue. Cost of living's gone up. So many people are deciding that they need a couple of jobs to handle that increase in the cost of living.
So, at the end of the day, it's good news. We want people to have jobs, but obviously there are implications for interest rates, which we'll come to in a moment. What's the economists might call it the NAIRU, but the rate of unemployment, which you kind of want to not make it too hot, not make it too cold, just right. What is that unemployment rate?
Well, that's the big question, Sean, and no one really knows where it is, including the Reserve Bank. But our forecast is for the unemployment rate to rise to 4.5% at the end of this year, and we think that'd be pretty close to the NAIRU. We do think the pace of wages growth will soften a bit this year as the inflation rate also continues to decelerate. So, around 4.5% is probably pretty close to the NAIRU.
Stay with me, Stephen. We'll be back in a minute. I'm speaking to Stephen Halmarick, Commonwealth Bank's Chief Economist. Okay, so let's talk about interest rates and what the Reserve Bank will do. Yesterday's number, well, it doesn't add to the argument to cut rates, that's for sure, but is it basically about the CPI figures next week? Is that kind of all important compared to yesterday?
Well, certainly the inflation numbers are really the critical component for the RBA's decision in early May and beyond that. I think the employment report did go a little bit of a way to say, well, actually the labour market is continuing to soften, but it's pretty slow, as we said. But the inflation numbers next week, really critical. We're going for 0.7% on the quarter for the CPI. So they'll take the annual rate of inflation down to 3.4% from 4.1% at the end of last year. And the trimmed mean, we're looking for an annual increase of about 3.7%. So the inflation rate's continuing to decelerate. And I think the important thing on that 3.4% CPI number is that is a touch lower than the Reserve Bank's forecast, which was 3.5%. So in contrast to what's happening in the US and actually in New Zealand, the inflation numbers have come in higher than their central bank's forecast. Our inflation numbers look like they're going to continue to be a little bit lower than the RBA's forecast, although marginally so.
Does it mean that the Reserve Bank Governor Michelle Bullock at her last press conference, or the one before, was asked whether or not she'd cut rates before it actually hit the Reserve Bank inflation, hit the 2 to 3% target band, and she kind of said, "Yep, if we think that it's going to hit the 2 to 3% target band, we'll cut." Given what's happened in the US and New Zealand, as you say, do you think that she might be a bit more tentative about that? Particularly if you get a 3.4% rate, you might have arguments to cut rates.
Yeah, so our base case is first rate cut from the RBA in September. And by then we would have had the June quarter CPI, which we think will be a little bit closer to 3%, a bit lower than the 3.4 for the March quarter. And then later in the year, we think by the end of this year, we'll be pretty much bang on 3%. So as you said, Michelle Bullock says, well, we can cut rates before we get into the target. But then the caveat was if we're really confident in our forecast that we're about to hit the target. Now, if global inflation, as measured particularly by the US, is higher than expected over the next 6 months, then that could limit the RBA's options. But our base case now is the US Federal Reserve starts cutting interest rates in September also. So we've moved that from July to September. And as the timing goes, the US Fed meeting is the week before the RBA board meeting in September. So on our current base case, the Fed eases the middle of September and we ease the week later. Now, there's 5 CPIs between now and the US Fed September board meeting, and at least 3 of those 5 are going to have to be a lot lower than what we've seen so far this year for the Fed to actually go through with that rate cut.
As an economist, when you're looking at the employment figures over the last 6 months in Australia, CPI, and then the inflation figures in the US are a better example than our inflation figures, how do you actually work out what's going on, given the noise?
Well, there's a lot going on, I guess, is the way to put it.
Sure.
But I think here in Australia, when we look at the national accounts numbers, particularly for the second half of 2023, they were pretty soft. Growth was 0.2% in the December quarter, 1.5% annual. What we can see, and really driven by a soft consumer. And what we can see from our own Commonwealth Bank internally generated data is the consumer has also been very soft in the first quarter of this year. So the annual rate of growth is going to continue to moderate, we think, over the first half of this year. Now, there's a lot of statistical noise, particularly with the employment numbers and, as you said, the inflation. But when you look at the string of data, quite a number of months worth of data, the pattern here is the higher interest rates are slowing the pace of economic growth. That eventually will continue to slow the rate of inflation, increase the unemployment rate marginally, and then we think the Reserve Bank can start getting back to a more neutral position on monetary policy rather than the quite tight position we've got at the moment.
So the central case, Stephen Halmarick, Chief Economist at the Commonwealth Bank, is September here in Australia. If there's a bias one way or another, is that later?
Yes, I think given the run of data globally, the bias probably is a bit later rather than earlier. But, here we are in the middle of April. September's still quite a few months away. So there's a lot of data between now and then. And, even as we've seen this year, markets and data can move very quickly. I mean, in January this year, the markets were pricing for a US rate cut in March, and now they're pricing for September, right? So things can move around quite a lot depending on the data flow. But we do think, as you said, base case is September for both the Fed and the RBA for the first rate cut.
Stephen, I have to ask you, how do you think Michelle Bullock's going? And I'm not even talking about monetary policy. I'm talking about being governor in a new world with press conferences and lots more debate about it and things like that.
I would say very good. I think the communication's been very clear, very, very open. The press conferences are, very well received. So far, I think, very good.
Fantastic. Stephen, thank you for talking to Fear and Greed.
My pleasure. Thanks, Sean.
That was Stephen Halmarick, Chief Economist at the Commonwealth Bank. This is the Fear and Greed Business Interview. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.